Good morning. Look at all this snow we got. Good morning, folks. So, first of all, let me apologize for being late because I intended to reschedule these Periscope. However, we have had snow and daycare is closed and hubby is out of home from work, and so lots has happened that has completely thrown me off my new schedule. I haven't even finished my hair. Good morning. Thank you for the heart. So, excuse me. I'm Rashida Clark. I am a realtor with Liz Moore and Associates, and we're going to talk quickly today because I have Minnie with me. So I'm going to try not to keep you guys on long because I don't want her to interrupt your learning process. We're going to talk about the top 2 reasons that my buyers get denied for a mortgage when they first apply. So, number 1 is... Okay, we can't have a pic. Sorry, guys. It's Mommy Realtor Day is what it is. Well, you can't have it, baby. The number 1 reason is credit score. Excuse me. Thank you. Happy New Year to you guys. I haven't been back since the New Year, have I? Have not been back. So, guys, if you could please share the scope, I would love that. And double tap the screen to give me hearts if you like and understand what I'm saying. So, the number 1 reason that people get denied is credit score, okay? And people think that's the only reason. But for the most part, you can qualify for a mortgage if you have at least a 580 for most lenders, all right? FHA, which is the Federal Housing Administration, they offer a first-time homebuyer product that many banks use, and that minimum credit score is 580. Good morning. Thank you. That minimum credit score is 580. Now, lenders can have a overlay score, which means that they can have require over and above a 580. So a lot of lenders do. But for the most part, if you have some money in the bank, and you have other compensating factors, like you've had your job for a very long time, you have a good savings, you have other people that be living in the house with you that may not necessarily be on the loan, but they have income that comes in. Those are compensating factors. Lenders will a lot of times go down to the 580. One of my favorite lenders, though, they usually look for a 620. Okay. Certain programs may look for a 640. So it just all depends on what lender you go to because they all can have different credit requirements. So after you meet the minimum credit score that they require, next they're looking at how much debt you have. So here's the kicker. A lot of people come to me and they say, I make $60,000 a year. How much house can I buy? Well, that depends, right? A lot of you guys know, especially if you are educating yourself about financial literacy, it doesn't matter how much money you make. It matters how much money you save and how much money you actually invest. If you you can make $1 million, and if you spend every single dime of that $1 million, you're not wealthy, okay? It doesn't have anything to do with how much you make. So if you make $60,000, but you have a crap ton of debt, that's still going to disqualify you. So, lenders are looking for somewhere between, and I say somewhere between because it depends on the program, the loan program that you're using. Somewhere between 41, max can sometimes go up to 45, maybe even a little bit higher, but a 41 to 45 debt to income ratio. So no more than 41% of your income. Let's just stick to 41. No more than 41% of your income is going out the door every month in debt. That's credit cards, that's car loans, that's student loans, that's, and student loans are tricky, I'll come back to that. That's tax liens, child support, anything that's gonna report to your credit, okay? So any of those things plus what your new mortgage would be. So no more than 41 to 45%. So the issue is a lot of people, especially my fellow millennials, have lots of student loans. And so that is starting to disqualify a lot of people. So I make the suggestion, if you have a lot of student loans, okay, Pay down your other debts. It's really the only way to compensate for the changes that they've made with qualifying people with student loans, because now they do not accept income-based repayments. They don't accept graduated repayments when you're qualifying for a loan. They won't change your payment for that, but they're going to apply 1% of your loan balance to your debt ratio. So if you owe $50,000 in student loans total, then they're going to take, so what would that be? $500, right? Is my math right? They're going to take $500 and they're going to use that as your monthly payment, because they won't accept graduated or income-based repayments or deferment or forbearance. So the number one reason, just to recap, that people get denied is they don't have the credit score. Number two, they have too much debt. That's number two, too much debt. If you guys follow me on Instagram, and I'm Rashida Clark, the realtor on Instagram, I will post the formula that I shared with my challenge students, my Stop Renting Challenge students, on the Instagram page later today, so that you can see it and calculate your debt ratio for yourself. So a lot of people forget about the debt ratio. They're concentrating on how much they make, and then they completely forget that they're in debt up to their eyeballs, and then they don't understand why they're getting denied. So that's why I want to talk about these two reasons why people are denied. I mean, number one, qualifying credit score. Number two, qualifying is your debt ratio. Quick, easy thing, guys. If you've got credit cards and they're maxed out, pay them down. Simple as that. Pay them down to about 30% of the limit. So if you have a limit of $1,000, your balance ideally should be no more than $300. Okay? Simple math. Seriously, like, especially, like I said, if you have student loans, and it's, the student loan fight is really irritating me, because so many people now have student loans, and I almost feel like they, the changes that they just made that I talked about, not accepting the graduated or income-based payments, is almost a slight against a lot of millennials and people that are trying to go to school to better themselves, that have to get student loans in order to make that happen. And now you're almost saying a lot of these people can't qualify, and people don't know what to do. So if you do have those student loans, you've got to trick the system and pay down your other debt to get your ratio in check. Okay? All right, guys. So I hope that helps. I am still going to try to do 9 a.m. I'm still going to try to do the 9 a.m. On next Monday, because hopefully we won't have another snow day. And there's going to be a snow day tomorrow because schools will close again tomorrow. So I hope you guys learned something. Thank you so much for watching. Thank you for the hearts. Thank you for inviting your followers. If you just hopped in, you can watch the replay. And I will post that formula, the debt ratio formula. And the reason I'm sharing that with you guys is because at least you will have some idea about where your debt ratio is before you go talk to the lender. So most people have some idea about their credit score. Hopefully you're actually checking your score. Credit Karma is not a good source for your actual score, guys. It's a good source for content, but not the score. Hopefully you're checking your score. I am going to try that, actually. I'm going to try Insta video and Twitter. Thank you so much. Hopefully you're checking your score at least fairly regularly so you know where you are. But then the other thing is also keeping your debt in check, your debt ratio. Oh, and one last nugget that I heard the other day from one of my favorite the Creditnista. When you have collections, when you have things that are charged off in collections, that actually counts toward your utilization, which can be really high. So I thought that was interesting. I'll share that information that she had here on my page because I think it's really interesting information. So thank you guys. I'll see you soon. Thanks for watching. Keep sharing the scope.